Chief Investment Officer here at McQueen Financial Advisors, and Jill Cernojevic, who also works on our investment team and interest rate risk team. She's a advisor that specializes in portfolio management, interest rate risk management, and she works with boards and management on deposit and loan strategies, which includes pricing, and also on strategic and regulatory matters. Welcome, Jill.
Thanks for having me, Craig. I appreciate it.
You're very welcome. Excited. This is the first of the 301 we've had for the many years, the Investments 101, Investments 201, and now we're going down the path of getting just a little more deep into technical areas with 301. So it's going to be a great day.
Yeah, absolutely.
From an administration standpoint, we are looking at today's webinar will be recorded, and at any point in time, it'll go up onto our navigator on the web. And if anybody wants to pull that down or view it or share it with a team member for learning or training purposes, you're always welcome to do that. As you're watching today's webinar, at the bottom of your screen, there'll be a Q&A tab. And if you want to ask a question, please just put it into the Q&A, and we will be monitoring that throughout the presentation. And we'll either answer it right away or we'll save it towards the end if it's appropriate for that as well. So, and then I think that covers the administration side. So Jill, take it away with today's overview.
Yeah, thank you, Craig. So we definitely have some exciting topics for you guys today. One of the first things we're going to talk about is we're going to talk about duration and optionality. We're going to define those terms, and we're also going to take a deeper dive on specific examples of securities with different duration and optionality. At the end, we're going to tie everything together by managing the balance sheet risk with the portfolio. So we can ask ourselves, how does duration and optionality affect our balance sheet? And also, how can we use the knowledge that we're gaining today in the webinar and apply it at your institution going forward? So let's jump right in.
Sounds
First,
great.
thanks. Awesome. We have duration first. So duration, I have the definition up there on the screen. So it is a measurement of the sensitivity of the price of a bond or other debt instrument to a change in interest rates. So said another way, it's also a measurement of bonds' interest rate risk that considers bonds' maturity, yield, coupon, and call features. Why are these things important? Understanding it allows us to better manage our interest rate risk by controlling the duration of investments in the portfolio. How can we do this? Craig, do you want to give us a couple examples of this?
Oh, absolutely. I loved your introduction and talking about the duration side. And as we go through, and we're going to start off on the asset side of the balance sheet, the duration and matching or mismatching is ultimately boils down to interest rate risk management. And it's kind of the core of understanding risk to your balance sheet. And we're going to talk about, like Jill mentioned, how the portfolio can be used as that tool to impact your overall balance sheet. The duration also does have capital impact, right? Assets with longer durations than their liabilities, and interest rates rise as we've experienced, right? Has had a reduction in the market value of assets more so than liabilities, and impacting overall capital calculations. And then there's also the whole regulatory compliance, which we love the regulators. We'd be remiss if we didn't mention them, right? We have to have policies staying within our policy limits. And how can we use that portfolio to help our balance sheet stay within those limits from a risk standpoint? So lots of great stuff, great introduction. And looking at the asset size on the screen here, you can see that, the asset size that we have is comprised of your earning assets, which basically is your investments and your loans, right? We have a lot of other fixed income assets and whatnot, but that's what the core is interest earning assets. And on the left side, we have just a simple picture of a price sensitivity of assets with a 6 duration. And you can see the steepness of that going from left to right. And left would be down 300. The middle of the page is your base value at 0 of unchanged from our current value. And the right is, declining below. And the steepness of that really is showing the amount of high sensitivity that a duration of a 6 would have on your with just your assets. Now, the right side is the slope for the sensitivity of your assets with a 3. So smaller, shorter duration of a 3. It's not as steep, and so as interest rates fall, your fixed rate assets don't appreciate as much, and when they rise, they don't depreciate as much. So that's just kind of a simple high level view of duration and how it has an impact on your price sensitivity, because that's what duration is, measurement of that price sensitivity. So if we go to the next page, we'll look at the liabilities, and just simple again, the opposite is true. Left-hand side is a 6 duration on your liabilities, which is your deposits, your borrowings, your broker deposits, even debt, interest-bearing liabilities. And the right is the duration for, a duration of a 3. And again, with the 6, you have more price sensitivity. And the art that we're going to be looking at as we talk about how to utilize different strategies and looking at the risk of different securities is the matches. How do we match up on the next page? Your duration of your assets versus your duration of your liabilities to show your overall interest rate risk of your balance sheet. Now here you'll see it's a perfect world, right? How often do you see a perfect world like this, Jill?
Not too often. It would
I
make my
don't.
job a lot easier.
It really, well, we probably wouldn't have them, right?
Yeah, there you go, right?
Yeah, so all I'm doing here is showing you is if you overlay 6 duration of your assets, a blue line, orange line, your 6 duration of your liabilities, you end up with a green perfect world where regardless of what happens to interest rates, you're going to have a capitalized institution, as long as you're starting out well capitalized, right? uh, and very, very low sensitivity. And we all know in our world and banking that um, we're not in the business of eliminating risk. We're in the business of managing risk, right? Yeah, because there's no way to get away from risk. And so we're going to look at some investments now as we roll forward to look at what would cause us in the investment world to actually change the risk of our balance sheet. Because before we head into it, I got to stop and pause because we talk about this often, and I really want to make sure to drill this point home is as we run our institutions, we're booking loans for customers, we're taking in money from customers, we're basically running a spread business. We've got some, hopefully, a lot of non-interest income, very little non-interest expenses, but ultimately, the investment portfolio is where we have 100% control of what type of instrument we're booking onto our balance sheet. So as you manage your investment portfolios, and this is Investments 301, as you manage those investment portfolios, you have to really take that approach of, all right, I do want to earn a decent yield, but first and foremost, I got to worry about safety, liquidity, and then your yield. That SLY principle always holds true. And how am I going to use this investment portfolio not only to put money that I'm not lending out to earn a little extra money, but also to help mitigate interest rate risk with my balance sheet? Because a purchase you make or many purchases on top of each other add up to what it will do is cause interest rate risk or reduce interest rate risk. It's a great tool. It's the biggest tool on your balance sheet that you have full control. Because if a customer comes in and wants a home mortgage, they're going to get a home mortgage. Or if they need an auto loan, they're going to get an auto loan. You don't have that control, and you don't have that control of how they prepay on those earning assets. The investment portfolio, depending on the type of investments you choose, You may have some control, you may have a lot of control, and that's what we're going to talk a little bit about. This instruments that are most common that we don't have a lot of control, and that's the big warning and red flags that we're going to talk about in a little bit.
Yeah,
Okay.
absolutely. Thanks, Craig. So
Yep.
that is great. Let's get into some other things. Let's get into optionality, which is what you were just talking about. Some of the different options within bond purchases or securities. So optionality, I'm going to just give you the definition to start off with. So they are options within a bond that give the issuer control beyond the basic terms of the bond. Just as Craig was talking about, there's control. You don't necessarily have that control over your loan portfolio, but we can have that control over our investment portfolio. So not said another way, it's also contracts within a bond between the seller and the purchaser that allows the seller to be in the control of the duration. So they hold the option, or excuse me, yeah, they hold the option and you hold the obligation. Second bullet point there is investments are either longer or shorter than planned. So why does that matter? Well, it's going to affect the cash flow from the portfolio as well as income as well. So we're going to take a look at a few different types of bonds going forward and look at some different optionality within those bonds and see how it affects things.
I love, Jill, how you had said, you're giving control to the issuer. We're the investor, right? Our
Correct.
audience is the investor. And
Hmm.
another way of saying that is basically they are selling you that optionality, right? And
Hmm.
it comes at a price, basically. You get a higher yield, but you're giving them that control, unfortunately. And that's what you get teased by brokers or the investment world of, hey, you can get an extra 30, 40, 50 basis points if you just have this little call feature or option on it.
Exactly, right? Pick up this little bit more yield, but then you don't have control over it, right?
Yeah, buyer
Exactly.
beware. So well
Exactly.
said.
Thank you. All right, so let's get into a couple different types of callable bonds. So I list a few of them at the top there. There are some different types, as I said. So the first one there is the one-time call. So it's basically, as it sounds, it's a one-time callable feature throughout the life of the bond. They could choose at any point to call it. Then the next one is annually. Again, just as it sounds, annually, they can exercise that call option if they want to. Same thing with quarterly. Quarterly, they have that call option to exercise as well as monthly. There are a couple different special or unique calls, one of them being the extraordinary call and then the make whole. So extraordinary call is a very specific call if certain events occur. It could be that the asset that was collateralized for the bond was damaged. Could be that the project fails. Could also be that the revenue source has dried up. In any of those instances, that extraordinary call can be exercised. Now, depending on where you purchased the bond, whether you purchased it at a premium or a discount, if you had purchased it at a premium, it may not make you whole. They could exercise that call and then you would have lost that premium if you had purchased it at a premium. Also, the make whole call sounds like it would make you whole, right? That's what it sounds like, but that's not necessarily always the case. With the make whole, they can have the early redemption, the bondholder pays a price that makes them whole based on the predetermined spread at the current treasury. Again, there's that premium and discount, right? If you were to purchase that bond at a premium, then that call is exercised. It may not make you whole. You still may have lost your premium. Craig, anything to add on that, on the
Yeah.
types of calls?
Yeah, I love that very last sentence there because when looking at a bond that has a make whole call, we see thousands of offerings in any given day from the brokerage world with how many broker dealers we have on our approved list. And when they're showing pricing of these bonds to us and to the street, they're not pricing in the make whole calls or the extraordinary calls. They're pricing it if it's a standard call. And that's why I love the way you said you've really got to look in and figure out what the calculation is of the redemption price for either of these, because the street does not price bonds to the worst make whole or worst extraordinary call. They'll price it to the worst regular call if it's applicable. And so just buyer beware in that.
Yeah, thank you. Absolutely. And then a couple different types of bonds that can have these call features: agencies, munis, corporates, mortgages in a sense, and also CDs can have callable features. So let's get into a little bit of the cash flow and how that optionality can affect our balance sheet. So we have that green line there. That is our typical ladder that we would look at for our cash flow. Looks a very healthy ladder shape. Um, if rates were to fall 300 basis points, we can see what would happen to our portfolio if it was consisted of all callable bonds. We can see that blue line there. Everything shifts up or kind of squishes up to the beginning there in those earlier years, those 24, 25, 26. All of that cash flow is coming back to us earlier than anticipated because those bonds were called. So now we have the reinvestment risk because now bond rates are a little bit lower. So we're having to reinvest those cash funds at lower interest rates.
Yeah, it doesn't look so nice if rates were to fall and we go from having to reinvest that green line for 24, $10 million to all of a sudden, whoa, $50 million in the lower rate environment. It's a really big shift, right? And then when rates are falling, what else is falling? Not only investment rates, but loan rates and your liabilities don't necessarily fall as quickly. They lag. So all of a sudden that would cause more margin compression.
Absolutely.
Yeah.
And then let's see what that's going to look into a very specific example of that. So with this callable bond here, we're looking at a callable agency. So at the top there, we can see what if we were to invest in a 5-year callable agency, looking into for maturity in 2029. So there we have our 5-year callable agency. Let's say 2 years in, it gets called, right? So we weren't earning a yield of 4.62 for 2 years, which we can see our income there is 92,000. Then again, if that bond gets called, what do we have to do for the remaining 3 years? Well, we're going to reinvest, right? Because we wanted to invest for 5 years. We're going to reinvest that money, but now we have to reinvest that money at a lower yield. So in this instance, let's say we were able to pick up a treasury for the remaining 3 years at a 3.43 yield. Again, showing our income there of 102,000. Adding up those two incomes together, it makes it 195,300. On the second example there on the bottom, the bullet agency, same scenario. If we were investing for 5 years, instead of purchasing that callable agency with a little bit more yield to begin with, we decided to go with a bullet agency, take a little bit less on yield, but it's going to be a bullet and stay steady for 5 years. So if that were to happen, again, the income from that would be 206,000. So at the bottom, we can see the income from the callable, the income from the bullet, and with income we gained just by having that bullet, not having that optionality on our bond.
Yeah. I like this example and how you're giving up income by sometimes even in a flat rate environment to a falling rate environment. So 2 out of 3 scenarios, you're making a little less money. The other thing that people think about that is when rates fall, you typically have appreciation of your in fixed investments, right? Rates go down, we bought something, rates go down, it's worth more than I paid for. On bonds that don't have optionality, like the 5-year bullet you have there, Jill, that
Mhm.
that holds true. You're gonna be able to benefit economically from that market appreciation. In the callable or bonds with optionality, they may appreciate some, but they don't appreciate as much because once they're appreciating, they're actually doing the net present value calculation to the call date, not the maturity date. And so the time value of money causes the callable not to appreciate in value in a falling rate environment as much because it's going to get called away. So they don't give it as much value. So that's another thing that makes it look a little bit better and easier to manage and understand that risk when using bonds without that optionality, in addition to foregoing some income.
Yeah, absolutely. Thank you, Craig. That was a really good one. Let's jump into another example. So let's jump into a different type of callable bond. It's going to be CMOs. Craig, I'm going to let you take this one.
Sure, thank you.
You're welcome.
I don't know if I'll be able to do as well, but I'll give it a try.
You got it.
So what we want to kind of talk about here, this is that next step of most common type of investment on our clients' balance sheets, the banking and credit unions are utilizing that have optionality, and for the most part, they are understood by the investors. Every now and again, they won't be because there'll be a new person coming in. The portfolio's built. They have some CMOs, some pass-throughs, some callables, and they just keep doing what the institution has done historically and not fully understanding how to truly use them as a tool. CMOs we wanted to talk a lot about because back in the Great Recession, where we had a lot of failures, credit unions and banks, some of it was not only CMOs, but private label CMOs. So the structures we're talking about today can be applied to either private label or agency backed. But what's really important to talk about is just how they're structured and how it can be misunderstood or can be causing more interest rate risk on your balance sheet, your portfolio and balance sheet than originally anticipated. So the CMOs are very similar when we're talking residential. So RMBS and CMBO, they're very similar because they're ultimately collateralized by mortgages. They're very different when it comes to how they perform, which we'll discuss in detail in a little bit. Ultimately, a mortgage-backed security pass-through, an MBS, they pass through principal and interest that the borrowers make on their mortgages. That's the underlying collateral as borrowers on mortgages, residential. The CMO, that's divided up into different tranches. And you could see, well, let's not look at the picture yet, but those different tranches have different priority of cash flows. So let's now look at the picture above. And Jill, I really like what you put together here is the top picture is a very good picture of a 30-year mortgage-backed security cash flow. You can see how it, outside of the very initial ramp up stage, you can see that it starts to ramp up from 0 months to 30, call it 30 months. It's not exactly 30, but 30. And then it starts to season, and then it's just got good, smooth principal and interest payments that we all make normally on our mortgages. And that's an investor owns a slice of those. So if it's a security that's issued for $100 million and our portfolio has $1 million of it, we'd get our 1% of that cash flow evenly distributed amongst all investors. The bottom is an example of the tranching that can take place with a CMO. So there's A, B, and C, and nicely labeled is right now the way I'm seeing it is the A tranche has the priority of cash flows, and then after A comes B's priority of cash flows, and then last in line, if you're not first, you're last, is tranche C.
Got to be somebody.
Gotta be somebody. I love it. So B and C, B not so much, C very much can be considered like a support tranche. And what I mean by that, they act like blockers. And so if there's a bunch of extra, let's say interest rates drop, right? They go down, mortgage rates go down 200 basis points, and homeowners start to repay their mortgages quickly. The A tranche will relatively stay the same in cash flows. And because B and C will act as blockers from that extra cash flows, those extra principal and interest payments that the pool is receiving, and that extra payments will go towards B and C, causing a little bit of different cash flow than originally anticipated from the investors that are invested in B and C, whereas A is a lot more stable. And that also is true as if rates soar up to more mortgage rates go back to 8%. And so nobody is really doing it unless they have to be forced to pay off a mortgage or pay extra payments. They're making the bare minimum payments because their mortgage rate's a really good rate. So there's not a lot of extra cash flow. A still gets its first 100% of its expected cash flows, and B and C gets what's left over. So that would cause B and C not to get as much and extend out its maturities a little bit. And that's kind of like a really good picture that you put together, Jill, of those three tranches and kind of how they correlate together, those waterfalls.
Thanks. Yeah, I thought it was a really good visualization of it.
Yeah. So let's start to look a little bit at a CMO, the shelf of a CMO, and what do we look at from different areas and characteristics. And then also after that, we'll look at some tranching. So I'll start with the first page, which is an overall description page. And in the upper left-hand corner above that red arrow, you'll see the tranche listed. It's FHR 5427. KC is a tranche, but the shelf is FHR 5427. And what we're kind of looking at on this original screen is that next row down, it says the collateral of what it is, has 100% FNCL, 6% new. And that what that means is it's collateralized by 6% 30-year mortgages. It gives an average mortgage rate of a 697, just under 7%. It gives the weighted average maturity and a weighted average life, or how old the loans are, the borrowers, how long has their mortgage has been outstanding. It looks to be about 6.5 years. Now, what's interesting as you're looking at this thing tells me it's the loans in this pool are 6.5 years old, but the collateral description has an N as a new. And so it wasn't packaged to write immediately, meaning it had some seasoning to the loans there. So it's interesting to look at that. And that's something to think about, right? When you look at vintage of loans, when they were booked and how they prepaid differently, kind of think about it from a CECL standpoint, from a vintage standpoint. But I'll keep going down as the other things that we kind of look at is in that same section, there's a number, and Jill, you might have a highlighter you could put on there.
Oh, yeah.
Is that number 10? It's a class description. It tells us what kind of CMOs that it is. So it has exchange, that means exchangeable, meaning you can, it doesn't happen often, but investors can go to the shelf and exchange what they currently have. Let's say this one is actually a 6% coupon, and let's just say we want to exchange it for a 4% coupon, right? Take some premium off the table. They were basically redeem our security and they reissue us a 4% coupon, and they pay us because we're now receiving less coupon payments. That's what exchangeable means. Very tedious, doesn't happen often, but it is. And sequential means it's a sequential pay. So there's other tranches that are sequentially paying in its order. In that current section by the lower red arrow kind of gives the current balance that's there if there's a factor. So this was originally issued at $40 million. It's factored down a little bit. So it went from 41.7 original to the factor is now 40.8. So that's how much is paid down since the bond came into existence, which it originally came into existence in June of this year. So it's very new security. And then also what's another thing that we're looking at is at the bottom of the page. And that kind of it's a newer security, but as you look at these bonds as they get older or seasoned and been in the market for a while, this table will slowly fill out with respect to its prepayment speeds. PSAs, CPRs, their factor and its coupon. The coupon will change as as it gets older, if it's a variable rate and gets into reset mode for an ARM. Some other really things to look at is just verifying that you're buying the right bond, the CUSIP number. That's the identifier. We don't need to get detailed into that. But I think that covers very well on this description page, Jill. Do you think there's anything else that's important? Maybe the docs or prospectus are up there?
Yeah, those could be up there, but I think you did a good job covering the majority of the description page. I have some other pages too we can dive a little bit deeper into and get some more information on the collateral of the CMO.
Okay, well, let's do that then.
Cool. All right, so the next thing I have here is pools. So as Craig mentioned, we have the pools, or take all the MBS and we pool them together in what we're going to call a pool, right? So we can also think of it as batches of loans that make up the CMO. So typically when we're looking at CMOs, we like to look at CMOs look at the loan count here. So this screen here shows us the different loan count that are within the pools. So we can see this first pool here has 3,600 loans. The one underneath it has 716. Now, typically when we like to look at a pool, we're looking for pools of over 1,000 loans in them. And the reason we look for over 1,000 loans, because it offers us diversification, and then also there's also safety in numbers, right? So something we typically steer away from that we see in CMOs as well is mega pools. Well, the definition of a mega pool is your pool of pools. So at that point, that can start to get, yes, that can start to get a little bit messy. It's also really hard to get an accurate head count or a loan count on those pools. So for example, the reason if we went with a pool with a low loan count, let's just say we found one that had five, just to be very simple, 5 loans in it. If one of those loans were to default, or if one of those loans were to not pay or something like that, that would be 20% of the pool, right? So that would have a huge impact on our cash flow. It would have a huge impact on our balance sheet, just because 1 out of 5, again, is 20% versus 1 out of 1,000. We got that safety in numbers. Yeah, anything else on the pools, Craig?
No,
Awesome.
you said it very well.
Awesome. All right, so next thing we look at is the geography, or where the loans are located that are inside the pool. So overall, the West and the South tend to pay over a little bit over on average. Tend to pay a little bit faster. And again, there's exceptions with every rule. Some of the states that tend to pay faster are Arizona and California. California, we have all the movie stars moving out there. We got the booming real estate market, right? Everybody wants to be in California. Some of the states that tend to pay slower are Texas, Florida, and New York. They have impediments to discourage necessarily refinancing the mortgage, such as recording taxes and rules to discourage loan churning or refinancing. So when we're looking at the CMO, we definitely want to take a good look at the geography and look that we have a good mix in there.
Gotcha. And that mix, if like you mentioned here, is California is typically a fast payer. We all know, just like some other states, in addition to speeds, there's some volatility that there certain markets experience from value of their properties are a little more volatile than say remote areas. But it's not necessarily terrible to have exposure to it, right, Jill?
Yeah, no, not at all. I
Right.
said
It's just
safety in the numbers as well, right? If you have a good mix.
Yeah, well said. Because fast states can offset low states, and you do want that diversity. So
Mhm.
you can have a little bit more reliance on the geography not having a huge impact on how the cash flows of your collateral actually to take place and then what you experience.
Yep, absolutely.
Yeah.
One of the other things we look at is servicers. So who is servicing these mortgages, right? So typically, we have the different servicers up there, and I have them circled, so we can see why is the servicing important. So there are different variations in prepayment speeds as well based on the servicer. So banks overall tend to pay a little bit slower. Mortgages are not necessarily their bread and butter. They have different loan products available and different things that they're doing. Their sole focus is not necessarily on mortgages. There's one up there that says less than 1%. That one typically tends to be about the average. That would consist of if someone had sold maybe just 1 or 2 loans into the pool, not necessarily, again, a huge portion, but maybe just a few loans. They just group those together as less than 1%. The other one that does tend to pay fast is your Rocket mortgages, your National Star mortgages. Those ones do tend to pay pre-faster because, again, mortgages are their bread and butter. Also, rates drop. If rates drop, they're going to be calling you and looking for refinance and all that stuff because that's their only game.
Right. So, hello, customer. I know you've been having your mortgage for a week now, but it's time to refi.
Exactly. Yeah. So again, that all affects how fast the loans prepay, right?
Yeah.
Next one here is quartiles. So this page I like, it's a little bit less information. It's almost a summary of a summary, if you will, again. This one just gives us some information on the loans themselves. Again, gives us the age, as Craig mentioned before. Some of these are seasoned, some of them are newer. So it shows us the median, minimum, and max in the pool. We can see the different credit scores on there as well. We can take a look at LTV. They have DTI on there as well as original loan size. Those things are all we take into consideration when we're underwriting these loans. So just as we take them into consideration while underwriting, we also want to take them into consideration while investing in the loan. Now we're going to get into tranching. Yay! So on this screen here, it looks a little bit busy, but we can see we're going to get into a few, looking at some specific tranches here. So this loan has, I think, about 13 tranches altogether, but we're going to be looking at 3 of them specifically. So the 3 we're going to be looking at are called KC, KQ, and KZ. What we're also going to look at on this page is the prepayment speed. So how fast are we expecting our cash flow to return to us? So this is the average prepayment speed for this CMO. Their base speed was 283 PSA, or again, how fast the loan is going to prepay. So if rates were to increase, decrease, we can see what happens to that cash flow within these tranches as we change the PSA. So going forward on this one, again, what if rates changed and our PSA, our prepayment speeds pick up dramatically, right? Rates fall, everybody's going to go refinance right now. What does that look like? What happens to our cash flow? So we can see here, everything shrunk up a little bit. So our overall weighted average life here, it dropped down. It was, in the previous page, it was 3, almost about a 3. It dropped down to a 0.9. So we can see our shortening of our cash flow. Same thing with KQ. That one is very, very short. That was a 0.8 previously. And in this one, it's a 0.2. KZ also shortens up as well. So that one, originally it was maturing in 51. Now it's going to be maturing in 36. So you can see all of that cash flow, again, just coming back to you faster than anticipated.
Wow, it varies a lot. Just kind of remembering what the previous page looked like, everything kind of shifted over.
Yeah, yep, absolutely. Now let's look at it in the other direction. So what if speeds were to slow down, right? If interest rates were to rise, like Craig said, no one's refinancing, everybody's staying in their mortgages. What does that look like? So looking at those same tranches, we can see KC there. Again, that extends quite a bit, right? It extends, your weighted average life is now over 6 years. KQ, same thing, that's over a year now, whereas previously it was under a year. Now it's extending to over a year. Same thing with KZ, that extends out quite a bit as well. That is over a 20-year weighted average life now. And we can see that prepayment speed drop to just 100, where in the base case it was about 200 and something. This case it's dropped down to cut in half, basically.
Mm. So, Jill, looking at these, it seems like that KC, that the top one, that's a 6.6 years. Originally, it had I don't remember now, 3-year average life.
3.1. Yep.
And so in a fast environment went from 3.1 down to 0.9 and now up to a slow speed up to a 6.6. That's a lot of volatility.
It is a lot of volatility, absolutely. And if you are looking and depending on your cash flow, you have that volatility in your cash flow.
Gotcha. So when evaluating a bond, um, is there how do you determine what up and down 300, down 100 speeds you use to see what is your volatility? Is it given by Bloomberg?
It is, yeah. Yes, exactly. They'll show you. Um, so the next page here, we can get into a little bit of a cash flow information.
Okay, excellent. And I see on this cash flow one, the prepay speed right in the middle on the left-hand side kind of defaults to what the markets feel the consensus are as what the prepayment speed would be of 283, correct?
Correct, yeah.
Gotcha. And this screen, we're not going to spend a lot of time here, but as you look at investing in a CMO, in addition to that structure screen on the prior, you also want to kind of look at the cash flows, especially in CMOs where they're a pool of a pool. Is that how I said you said it, Jill?
Yep, full of pools.
Pool of pools. It's summertime coming into fall. It's good to be talking about pools. And sometimes, if one of those pools that are re-securitized into a new CMO, it could be a money market tranche or a money market pool, where instead of having that slow ramp up of cash flows, you could have a huge amount of cash flows in the first 2 years and then dropping far, far off. And the cash flows may look extremely different. So I'm just giving one of the very many scenarios. So it's extremely important to kind of to look at this page and then also stress this page with different prepayment speeds. You definitely look at the consensus speed like this screen is, but also, all right, what does it look like if it's slowed down and what happens if it speeds up? What's really important is similar to Jill, you were talking about paying a premium for a bond if it's callable, really modeling what will happen to those cash flows and yields if rates drop. It's the same thing with these, is if you're paying a premium for a CMO and depending on the collateral, it could be vary so much where you have a negative yield actually for quite some time. So very important to look at this stuff.
Yeah.
Okay. All right. Well, to continue on with the tranches, where are we at? Right here. Thank you. All right. Another thing to look at when considering CMOs is the high risk security test. And a lot of policies out there that I've seen, and Jill, you can speak as well about this, is within an investment policy, you have a couple of limitations. And more often than not is the price change test in an investment policy. What does this CMO's price do in an up and down environment of 300 basis points? Is that the most common limit that you've seen in policies?
Um, yeah, I would say so. As far as price sensitivity and things like that. Yes,
Yeah,
absolutely.
for CMOs
Hmm.
and mortgages as well.
Yeah.
So the high risk security test does incorporate that in, and that's the test number 3, as you can see on this page. But as you shift to the left, there's also a test 1 and a test 2. And there's test 1, and test 1 is basically saying what is the max weighted average life based on existing purchasing right now. Meaning a security will first and foremost needs to have an average life of 10 or less in order to pass test 1 for a high risk security test. And this one at base speeds with no shift is 0.79. So check mark, it passes test 1. And test 2, it is how much does that weighted average life change? And it measures it slightly differently. It has a limitation that uh, it can only extend 4 in a rising rate up 300 basis points, and it only can decline by 6 in a falling rate environment. And so this bond, you can see the actual column, it hardly changes at all. So Jill, I'm guessing it's one of the bonds that didn't on those SPA screen doesn't have a lot of volatility there. Maybe not the top one, not the bottom, but that middle one. That's what I'm
Yes.
guessing here.
Yep. This is one of the where the cash flow comes back pretty early. Yeah.
Yeah. And then the third test is hey, the price sensitivity must not change more than 17% in a shock rate environment and when you're initially buying it. You can see this one, rates fall 300 basis points, it only goes down 0.6 on a price change, so very, very stable. And in a rising rate environment, it declines only 3.4%. So well within the 17% regulatory limit there for it to pass. And you can see the green check mark, the green bar, it passes that. And the other thing to look at when looking at this is, what you put in there is the price that you buy it at in upper left-hand corner, along with settlement date. The prepay sources, it's interesting to point out there, it says B median, and that goes back to what is the medium price that this, or speed at which this would prepay, not only based on today's rates, but also if rates were to go up or down. You can see those prepayment speeds in the second to left column are what drives some of the sensitivity there. The PSA negative 300 is 1410, and in a down up 300 it's only 103. So you can, and running some scenarios in different screens, say, you know what, I want to make up my own prepayment speeds. Is that possible, Jill?
Yeah, absolutely. You can run lots of different scenarios.
Okay. Yeah. So the one thing I do like, especially when you're talking about a rate environment that's expecting to change. Like right now, the market consensus is that rates are going to come down a little bit more than they already have. Some people say a lot, but we're not getting into economics right now. But let's just say we all agree that rates are going to drop like a rock. Let's just say we all agree. I'm not saying we do. You can also do a vector of prepayment speeds as well, right?
Absolutely. And with a vector, then you can run different speeds at different time frames.
Run 283, which is the consensus on this, for 18 months, and then drop it down to 100 for 36 months, and then ramp it back up to 500 for the remainder of the life. Is that a good example of what we could do?
Yeah, great example.
Yeah. So that's other things, is when you're looking at managing your investment portfolio, it's really important to run various scenarios so you get comfortable with how it's going to perform, its yield, and if it doesn't perform the way you expect, you've got these other scenarios that you've run that say, even if I'm wrong and rates do go up and it performs like this, it's still stable enough, or it fits my existing for other investment securities and balance sheet to where it's not going to cause too much risk. Okay.
Mhm.
All right, let's move on to the next one here and look at the time really quick. We're going to speed up the next two ones. This is a borderline pass. I love the title that you put on here, Jill, borderline pass. And as you did that red circle on test 3,
Mhm.
you can see that in the rising rate environment, the bottom row, it declines in value of 14.3% there. And that's interesting. So that's pretty close to that 17% limit. And in the test 2, it also is pretty close. Actual weighted average life goes out to 354. So that was an increase, which it gets closer to that increase of 4, right? Yeah, increases
Mhm.
354 instead, and so it still stays within there. And the speeds, though, just so you know, on the left, second from the left column, those speeds are all still the same as the previous bond. But what's materially different, Jill, is at the top and show which tranche we're looking at now.
Mhm.
So here, this is the same shelf. It's 5427, but this is the KC tranche. If you go backwards one page, is that
Yep.
possible?
Yeah,
Go one page.
absolutely.
That one was the KQ tranche at the top there. So now we're kind of looking at how does this test impact based on which tranche you own. All right, so let's go to the borderline pass.
Let's
And what's
fail.
and there's the fail. Oh boy, there's red on this screen. We don't
Right.
like
Yeah.
red, huh?
Nope.
And which tranche is this? At the
This is
top middle?
KZ.
KZ. All right. So here it doesn't pass all 3 tests, as crazy as it sounds, right? Test 3, it devalues 40%. Oh my gosh. Whew, if rates go up 300 basis points, I start thinking about like SVB, right? Silicon
Yeah.
Valley Bank.
No, none of
What
that.
did they have? What did they mismatch? The liquidity event, rates were up. They couldn't sell because it was too big of a loss. if rates went up 300 basis points and the price changed 40%, slide over to that security price column there with your highlighter there,
Mhm.
Jill. And you can look at that column. The middle row is at a 104 and 27, 104.28 is what they would have paid today. But if rates went up 300, the price would drop to 62. So you would lose, gosh, what is that? 48 cents on the dollar if you
Yeah.
had to liquidate, right?
Mhm.
Again, SVB, bank failure.
Yeah.
Um, Not that if you buy one of these, you'll definitely fail because, again, you got to look at your entire balance sheet, your portfolio. But you can see the price change test. You can see the weighted average life change shot out. It went out 9 years. And on the third column from the left, the base was longer than 10. So right there, you should have been saying, all right, should I be buying something with 11.79 average life? And if rates go up, it'll be over a 20-year average life security. So now, what I am guessing though is of all three bonds, even though this one fails, what's the Kool-Aid? But you can get a 5.59 yield.
Right? Pick up a little bit more yield on it. Yes.
Yeah, isn't that a little extra yield, and it's only one bond. So why not do it, right?
Uh,
And
uh, worth the
sound
risk, right?
I'm
Always. No.
I'm I'm sounding like a broker, right? It happens. It happens. One little
Yes.
morsel of a bond's not going to kill you. Well, if I bought 1 million of it and it devalued by 480,000, that's a big chunk. That's a lot of write-off that I would have to do, right?
Oh, absolutely.
So
For
very
sure.
important. All right, well, let's move forward here
Mhm.
before we run out of time. And what do we got here?
We're going to be talking about managing the balance sheet and risk using that portfolio, right? Just as we've talked about a lot of different things, talked about that optionality, talked about that duration. Now, how do we use them going forward to help manage our risk in the portfolio?
Okay.
So one of the first things we're going to look at is NEV, or our net economic value, or again, we can think of it as the net present value of our current cash flows, right? So we're going to take a look at all three different tranches we just talked about, the KZ, KQ, and KC, and how the NEV is affected. So I called this line P. This was our passing CMO tranche. That one, it was KQ. So we can see the scale on this one. I have +5 to -5. Not a huge change here, not a huge volatility. Again, we drop down to about -3, -4 when rates go up.
Yeah,
I'm
that's
gonna,
very stable. It doesn't lose hardly any value at all.
no, no, looks pretty flat. And my base case there is just my zero line, right? So we look at a borderline passing CMO. That was our next one. So we can see that one has a little bit more volatility again in the down rates. We're down to negative, 15-ish area where that P is looking a little bit smaller, right? And doesn't look quite as bad as it was when that borderline one comes into play. Same thing on the next one. Again, we're going to add that failing CMO. So we can see the huge swing there again between the passing tranche and the tranche that fails that test, right? And how it affects our NEV and how it affects our value.
Yeah, it just falls off.
Correct, yeah.
And depending on how much you own, and again, I know I was joking about, hey, just 1 million, and you're a $500 million institution. What's 1 million? Get that extra 560 yield, versus the conservative yield of, call it 480, right? You're getting an extra 100 basis points with no credit risk, right? Because it's backed by Freddie Mac.
Yeah,
You know,
yep, exactly.
you got
Sounds
to be
really good,
careful.
right?
It does sound really good. It can do an
Hmm.
overall impact of how your NEV calculation is, your capital or your AOCI.
Sounds good, but exactly. Then when you see it like this, you're like, oh, it sounds a little bit different now.
Yeah, I agree.
Absolutely. Do you want to get into how it affects our income?
Yeah, so income's a little interesting because we've been talking about value of security, right? And what happens to any fixed rate, anything changes as rates go up or down. But now let's think about an amortizing security like a CMO and how it really impacts expected income or net interest income. So on this chart, I'd love because you've got your bullet security, your net interest income, regardless what happens to interest rates, or you're going to kind of be the same. You'll have a little volatility. That bullet lines, it looks like it's on zero, but slightly off because you're going to have reinvestment of coupon interest, right? And if rates go up, you've got your coupon interest, you're investing a little higher. Um, and if you look at now you have the CMO, and that's the past CMO. And actually, as rates go up as modeled, your CMO, your net interest income goes down. And that's just sometimes it's counterintuitive, but the reason being is as rates go up, this is an amortizing security. And so again, the borrowers that are actually providing the cash flows for the securities, the borrowers that have the mortgages out on their homes, they're going to pay at a lower rate of speed. And so you're going to get less prepayment speeds taking place, so less cash flow coming back to you as rates rise, and therefore you can't reinvest as much in the higher rate environments. Your income actually goes down a little bit, and the opposite's true when you, but again, that's a passing CMO, so it's not that volatile, right? You look at the failed CMO, right, from the same tranche, but the failed CMO, you can see that rate drop goes, the net interest income goes down a lot, because remember, they're the blockers. Rates go up, there's not a lot of cash flow for all the securities issued. And so the support tranche, or that more volatile tranche, gets even less in a rising rate environment. So your net interest income actually goes down in this type of security. Kind of crazy, isn't it? Okay. Jill, I think you're on mute.
That helps, huh? Right?
Yeah, a little
Uh,
bit.
yeah, exactly. Thank you.
You're
I was
welcome.
just going to say, yes, exactly. That line was a lot steeper. And then for here, I just skipped ahead for you because I know we're a little bit short on time. We just skipped the borderline in the past, but they're all on this screen for you.
Yeah, nice, great depiction of, even though you're buying it from day one on a failed one, really good income, it doesn't necessarily perform in different environments better than, say, a more conservative one. So again, how do these all fit with your total balance sheet? I think that kind of wraps us up for today, because we only had an hour. We're at 2:58 on the hour.
Mhm.
There's a lot more in detail for CMOs. This is a great next step at 301 to dig in. Again, I want to repeat, we have investments 101, 201, and then starting tomorrow, investments 301 will be on our website. Go to our website, there's a webinar tab, and it has all the historical webinars that we hold for training and economic reasons. Jill, you are one of our shining stars advisors here at McQueen Financial. Really, really appreciate your time and expertise today. Absolutely. Thank you for joining us and
Thanks for having me. I appreciate
share.
it.
Yep, you're welcome. The last page here is just to let everybody know our next webinar is ALM 301. Fabulous, great content. It's on September 11th from 2 to 3 p.m. Eastern Standard Time. You can register either on our website or through one of your advisors' email invites that you have at the bottom of their email. So please register for that. Share it with people within your institution. It's great education, great training. It's great for boards as well. Um, and thank you for attending. We really appreciate the relationship. If you have questions, don't hesitate to reach out to Jill or myself or your advisor here at McQueen Financial. We're here to help.